All right. Today is Tuesday, the 24th of June. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. It feels like a long week, but we're just Tuesday. We got 3 more days, folks. And things are about to get a little bit more interesting, even though we are in the summer season, which is supposed to be slow. But a few things that we need to talk about. And in this video, we're going to talk about the bullish case, bearish case, and let's make a determination after that. Anyhow, without further ado, let's begin with the headlines of the day. Let's begin with the geopolitics, because I know a lot of folks are saying, Mav, it's over. We got a peace deal now. And Trump was a genius and he brokered this peace through strength and all of that. And it's now the matter is sealed and done. Got to be careful what you're talking about, because I think this ceasefire, while it's good, and I applaud the president for taking the peace approach, especially today. Today it became sort of an Orange Man fan, which I think is going to last for about 2 more days. And then he's going to do something stupid in trade, and we're not going to become fans anymore. But the ceasefire is flimsy, and things will escalate again, no doubt in my mind. And the reason is the main objective of this war, to begin with, from the point of view of Israel, which is regime change and elimination, not just damaging, but elimination of the nuclear program, that has not been achieved yet. And we're going to open that can of worms at some point down the road. I mean, the ceasefire was about to be broken today, because after the ceasefire, Israel says Iran launched more missiles after ceasefire. Iranian military denies that. So somebody's fucking around here. Either the Israelis want to have an excuse to break the ceasefire, and they shot a bunch of Fugazi rockets and they shot them down later on, or somebody's in Iran trying to start some shit. Who knows? But I don't think this is going to last. With that being said, the president today was really, really firm about, hey, I want to win that Nobel Peace Prize. Don't fuck it up, please. So when we got that news that, there are rockets that got shot in Israel after the ceasefire, of course, the Israelis want to overreact and go crazy, and that is per usual. But this time around, Donald Trump exercised America's dominance, which is what was pissing me off about all of this. If we're leading the world, we're the most powerful country in the world, especially if we're bankrolling some country. We're giving them aid, billions of dollars every year. We get to call the shots. You don't get to call the shots. Just because you have a bunch of politicians in the Epstein files. And today he did exercise that American dominance. He said, pretty much, if you do it, if you fly the planes and hit Iran because somebody tried to break the ceasefire, it was a really firm conversation. And according to sources, he told Bibi to go fuck himself. If he does it, he can go fuck himself. And of course, what did the Israelis do? They obeyed. That's how you exercise America's dominance. This is how you achieve a peaceful agreement. You got to be tough on the enemies, tough on the allies too. But again, as I said, I think that Israel and Iran will do something crazy. They're going to try to play funny games to break this ceasefire agreement. And I'll let you know exactly how. And even Trump today, out of frustration, said this.
We basically have 2 countries that have been fighting so long and so hard that they don't know what the fuck they're doing. Do you understand that?
And that's why I'm going to make sure in this program tonight, I'm going to use the F word about 47 times. So keep the kids away. But why do I think this is going to be problematic down the road? Because today we got exclusive intel. This is at least what CNN says, even though other, of course, sources agreed and already, the Maverick Intelligence Agency already told you that in the weekend, that the bombs we dropped in the nuclear facilities probably did nothing of significance, maybe minor damage. And we still got the missing uranium. Where the hell did that go? And of course, the New York Times came out confirming these kind of reports. Israeli intelligence came out confirming these reports. That all of this could have been just theater and no real damage happened. That maybe we've informed the Iranians, they pulled the uranium out, we dropped a bunch of bombs, made a bunch of holes in the mountain, and it's all just a charade. And the problem that I see is right now, after the war happened, what do you think Iran is going to do? Are they just going to negotiate in good faith and say, okay, folks, we're going to give up our uranium and nuclear ambitions? I don't think that's going to happen. I think they're going to exercise the 6th option, as I talked about in the weekend video. And as we get signs of that, in the Israeli side, they see that mission is not accomplished. And they might try to find a way to break the ceasefire, to stop Iran from enriching more uranium or They might even accuse Iran without any evidence. A lot of shit could happen here. But of course, what's keeping a lid on everything right now, as I said on Twitter before, the only thing that could be right now preventing World War III is Trump's obsession about that Nobel Peace Prize. I don't know what the deadline on that is, but after that deadline, either he wins or doesn't win. I think we're going to get in trouble again. Anyhow, the second story of the day, the headline of the day, is what we talked about last night. That the focus of the market right now is going to shift toward the monetary policy and the trade policy, away from geopolitics until something flares up. And that means that your boy Jay Powell today testifying in Congress, and he pretty much said, yeah, no rate cuts in July. Don't care. I don't want to do it in July and then wait in the summer and then get a surprise. Not going to do it. We're going to stick to the September timeline. Of course, he didn't say that, but he already said that 2 rate cuts by the end of the year. And the market right now is assuming that it's going to be September and December. Powell said that the Fed can start cutting again, quote, if it turns out that inflation pressures do remain contained, end quote, but that it wouldn't be anytime soon. He added that the economy may show meaningful effects from the tariffs in either June, July, or August. Why is that the case? Because anybody who looks at the PMI data, all of that increase in input prices by manufacturers and services, that's going to be passed down to the end consumer sooner than later. And it has to be taken seriously when we talk about the rate cuts conversation. I think Jay Powell, for mysterious reasons, of course, because you got to remember, he cut rates by 50 basis points right before the elections. Now, all of a sudden, Jay Powell is rational and saying, no, I can't do it because we got the PMI data and inflation in the pipeline. Wonder what happened to Jay Powell. But analysts at JP Morgan, Goldman Sachs, Barclays, Nomura, Deutsche Bank all still estimate just 1 rate cut this year in December. That's going to be a massive upset to the market if they're right, because the market is pricing in 2 rate cuts. If we get 1, the market is going to get hit. You can bet on it. Powell told lawmakers I would not want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. Again, rational Powell. What happened? He's no longer the guy who just want to cut rates and fluff up the stock market. At end of the year quarter-point rate cut likely won't set well with Trump, who has repeatedly called for supersized rate cuts. You know, part of me wished that Powell would just give him the supersized rate cut, the 50 basis points, so inflation can explode higher. And that's going to seal the deal in the market and the economy. But again, these are twisted fantasies. Anyways, the president has said that the federal government is stuck making massive interest rate payments on its debt because the Fed has not lowered rates. That's bullshit, of course. We're paying because we're borrowing more. And the worst case scenario is the Fed cuts rates and we see the short end of the yield curve rates going down, but in the long end going higher in the 10 all the way to the 30 because of that inflation risk. So I don't know if Trump knows this or not, but the Federal Reserve has control over the short end of the yield curve. They don't have any control over the long end of the yield curve, which impacts interest rates in the economy. That's all about the bond auctions, the debt issue, the Treasury issuing and buybacks. That's what impacts the long end of the yield curve. Anyhow, according to Polymarket, Fed decision in July, 81%, the majority of the odds say no change. If that begins to become, let's say, 30%, 25% decrease, the market is going to love it, especially if it is for the good reasons, not a recession reason. My 2 cents, I don't think Jay Powell is going to do it, so the odds for no change will probably go to the 90s. What matters right now, what happens in September. And for now, if the Fed doesn't do the rate cut in July, then the market will be disappointed, but it's not going to be a reason to flush. Until, of course, if we get evidence that the September cuts have been eliminated. If that is the case, it'll be upsetting. So what happens, let's say if the Federal Reserve does nothing in July, the focus will be back on the trade policy because we're going to have a lot of deadlines. And the bill, by the way, passing of the bill, we have a deadline of 4th of July. That's even before the FOMC. And not to mention, of course, if we see anything happening in the geopolitics, which I'm betting on, that we're going to see a flare-up again. Anyhow, the third headline of the day, and this is a really good macroeconomic indicator, FedEx reported earnings today, and they said the profits will be below analyst targets. So they cut the forecast and they said, we're not going to give you more guidance from this point on. And they're not giving guidance because of economic uncertainty. They don't know what's going to happen with the tariffs. Anyhow, the stock of FedEx went down by 5% after hours. Now, there's an important finding from this report. What you're looking at right now is the income statement. You look at total revenue up about 1% year on year, which says that we have sort of stagnation in the economy. There is no growth. It's just 1%. Then you look down at operating income that's up 15% year on year. Pretty good, you might say. Sure. But what is the major contributor to the increase in operating income year on year for FedEx? Here it is. Fuel cost. Fuel costs are down 24% year on year. This is why a geopolitical flare-up that pushes crude oil just above 70, 75. We don't need to go crazy in the 90s, 100s. That's going to crash the economy. You just need to maintain 70 and above for a little bit. And you're going to begin to see the profitability of a lot of companies in the economy, a lot of companies in the stock market beginning to get hit. And believe it or not, folks say the fundamentals don't matter, but stocks reflect the outlook for profitability and revenue growth. It's pretty accurate, at least in the long run. In the short term, you can see crazy things, but in the long run, the stock market pretty much tries to speculate on what the revenue growth is going to be for certain companies. For others, like FedEx, what the profit is going to be. So every time you see oil going higher, the market is going to guess that, okay, if these prices are sustained for oil above 70, 75, then companies like the airliners, companies like FedEx, the profitability will begin to go down. So they become a short for us investors and traders. Now, the most interesting conversation of today's program is, as I said in the weekend video, we're going to have a break. A break is coming really, really soon. So the neutral strategy of consolidation will be changed. Are we going to have a break to the upside or the downside? Right now, if you look at the action, the charts right now, of course, everybody's betting that it's going to be to the upside. But let's discuss the cases before we jump the gun here. The bullish case. We have a bunch of evidence here that supports that it's going to be a break to the upside. Among them, HYG and J&K. This is, of course, measuring the risk, the credit risk in the economy. I'm looking at the chart of the HYG weekly chart. It's above 78, my bullish indicator for the market, and it appears to be heading for the highs. I mean, it looks like a good-looking chart right here. If that is the case, then it is supporting that the market is going to break to the upside. Then we have psychology. What do I mean by psychology? Pretty much it's FOMO. It's saying, look, the market been consolidating. We have thrown a lot of shit in the market, from trade policies, from geopolitics, for all kind of scares. And it just keeps coming back. And maybe I'm not going to get a better price to enter. Maybe I missed out, and now we're going to chase the price higher. So psychology is in favor of a break to the upside. Then we got bond yields. Now, if I'm looking at the 30-year bond yield, there's still a lot of risk that this could be a series of higher highs and higher lows. We pass above 5%. But notice what happened at least in the month of June. We've been trading below 5%, and the market been holding. If the assumption is that we continue to trade below 5%, that's bullish for the market. Once we go above 5%, it's going to be problematic. Then we also have speculation mania. All what you got to do is look at stocks, the recent IPOs like Circle, like CoreWeave. You look at the retail investors' names like Palantir, like Coinbase. The speculation is still healthy in the market, and that shows that there's still appetite for taking risk in this market, and that's bullish. Seasonality is also among the bullish reasons. So if we look at the seasonality for the month of July, usually it is a good month. So the seasonality is in favor of a break to the upside, but here's the problem. You see what happens in August and then what happens in September, which is usually a bad month for the market. So here's a really interesting piece for you. If you look at the growth of $100, if you just invest $100 in the SPY, the S&P 500 since 1993, that was before you were born, right? Anyways, if you invested that $100 and you just held the SPY from November to April, and then you take a break for the summer and all the way to September, you only come back and participate October to April, you've outperformed everybody. The value of that $100 would be $831 right now. If you own the stock market from May to October, which includes the summer season, that $100 after all of these years is only $271 now. In other words, the summer month all the way leading to September, maybe July is good, but then you take the cumulative evidence for all the summer, all the way to September, and it just doesn't look good. It looks negative all in all. So keep that in mind. But for July, right now, the seasonality is suggesting that we get a break to the upside. Then we have rate pressure. What do I mean by that? It's not just coming from the White House. A lot of Fed officials, you heard Goolsbee, the Golden Piss from Chicago, you heard a lot of them, the zombies, today coming out saying, yeah, I would support a rate cut in July. They're beginning to go against Powell. And maybe at some point, Powell, numbskull Powell, probably going to succumb to the pressure and say, okay, let's do it. Then we have gold as part of the bullish thesis. But hold your horses, because it's also in the bear case. Looking at gold here, the idea is if we see outflows out of gold, that money's going to rotate to the stock market. And so far, in the month of June, we've seen a drop top to the recent bottom that we got of about 4 to 5%. Now, in my opinion, this is not enough to say that we have outflows out of gold to chase the market. What it says to me is some traders, decided to buy gold as a geopolitical hedge. And now that we have a resolution in the geopolitics, they don't need that anymore. So maybe some of that money is going toward the stock market, which is bullish, but not the kind of outflow that we need to say that, okay, we got a rotation now. We have a bold level of confidence that investors no longer need gold and they're going to rotate towards stocks. Maybe if we make all-time highs, that's going to happen, but I don't think right now. But again, keep an eye on gold. If it continues to go down, I think that's going to be part of the bullish thesis in the market. The other one is small caps. So if you look at the monthly performance here for June all the way till we close today, the Russell 2000 is leading the pack. Russell in green, you have the NASDAQ in blue, you have the SPY in red. So if the Russell 2000 small caps is leading, what does that say? It says you probably have upside risk. We are in a growth kind of period. I don't know if that performance is going to continue to last or not, but for now, it is part of the bullish evidence. Looking at the bearish case, we have the mega caps. Now, if you look at the mega caps, and by the way, the Magnificent Seven right now, NVIDIA, Meta, Microsoft, Apple, Google, Amazon, and AVGO, Broadcom, not Tesla. Tesla's a piece of shit. AVGO is actually bigger weight than Google, believe it or not. So, if you look at the performance since December, going into 2025, the majority of these stocks have been stalling. So you have Apple down 20%, you have Google down about 15%, you have Amazon down about 8 to 9%. You only have AVGO, you have Microsoft, you have Meta and NVIDIA higher. So NVIDIA and Meta right now doing the heavy lifting, but the rest kind of stalled. So there is a lot of concern here. Now, when we talk about the CapEx spending, a lot of these companies will begin to spend more out of the revenue. So look at Meta, for example, leading the market right now. In 24, they spent about 24% of their revenue in CapEx. This year, they're going to spend 39%. So the outperformance by Meta is going to stop. Then who's going to lead the market? Who's going to do the heavy lifting here? Because we know this is all about weight. You can have all of the other sectors up. If these big names are down, doesn't matter. The market will be down too. You look at Microsoft increasing from 23 to 29%, Alphabet from 15 to 19%, Amazon from 12 to 14%. So all of that spending is going to dent profitability. And as I said, stocks track profitability. And in this case, it leads us to think that probably the big cap's going to stall and their performance is not going to be pretty good this year. Back to the bearish case, how about valuation, risk versus reward? So if you look at the performance of stocks versus bonds, SPY to TLT ratio, we have reached pretty much the same levels where we topped and we began to head down after the inauguration. With the risks that we have all over the place, I think a lot of investors will be saying, you know what, the valuations, the risk versus reward is not pretty good. I'm not sure if that's going to be enough reason to sell, but it could be keeping a lot of money in the sidelines. And this is why you see the money market funds, they continue to grow. Everybody said, oh, wait till the trillions come out of the money market funds and chase stocks. But those kind of investors are saying, wait a minute, I'm catching 3 or 4% risk-free in my money market funds, sometimes higher. And I don't like the valuations. So I'm not going to join here. Give me better valuations, then I'm going to join. Such as, by the way, what we got in the aftermath of Liberation Day. But right now, this level's right here. I don't think it's going to happen. Then we go to uncertainty. And uncertainty goes back to the 4 reasons for a rug pull that we discussed, I believe, a week ago. The bill, China trade fallout, could be AU trade fallout. Any trade fallout will be problematic. The macro, any inflation data, any recession data would be problematic. And of course, the geopolitics. If it moves oil, as you've seen from FedEx Earnings, that's going to be a problem. Now, the bill is going to take center stage because we have the deadline coming in 4th of July. And trade is also going to take center stage because we have a July deadline for the EU deal. And soon enough, we're going to hit the 90 days extensions for China, Japan, and the rest of them. The president says no one goes on vacation. He wants the bill passed by the 4th of July. What is the problem of passing the bill as it is right now? It's going to lead to higher interest rates. It's going to lead to higher bond yields. And now you're beginning to chip away of the bullish case and begin to add to the bearish case. Not to mention, of course, the debates that we're going to see until this bill is passed. Cutting spending, that's a negative. Increasing taxes, that's a negative. And then, of course, we have gold. So gold adds to the evidence with money market funds that there are a lot of investors who say, no, thanks. I don't like what's going on in the market right now. I'm just going to buy the dips in gold. I'm going to buy money market funds and take it easy. If that is the case, if folks continue to buy gold, the dips in gold, That's going to come at the expense of the stock market. Anyhow, let me know what do you think here. Which case is more compelling to you? Because you got to make the decision here and bet on it. I can give you my 2 cents, but at the end of the day, I gave you the evidence. You look at it, you decide what you want to do. Let me know in the comments what do you think is the more compelling case. Because you got JP Morgan, the manipulation desk, of course. They come out and say it's a great time to be bulled up again. And JP Morgan have such a huge trade desk, they can actually manipulate the market higher single-handedly. Now, I want to segue to the morning brief. You can pause and read all of this for yourself here, but I stressed the significance of the 2-year yield. You have to watch that chart because so long as we head down, that is saying the Fed policy is probably going to be easier. That's going to be positive for the market. If the 2-year begins to tick higher, that's going to be problematic for the market. We also talked about zero DTE dynamics, and I suggested that the SPY, the most important number is 604. If we trade above, we're going to hit the target, the calls target at 607. If we lose 604, we're going to hit the target for the puts if we see volume at 600. And I suggested that we're probably going to hit 607, then the market is going to push, the market maker that is going to push us down closer to 604, 605 to achieve maximum pain. Now that didn't happen. We closed just a touch below 607. So what happened here? Let's look at the data. What you're looking at right now is the data for call options with the expiration date of today. So right off the gate, you look at 604, that's when we see increase in the OI change. We see high number of open interest, but that's with the volume meaning what's traded today. Open interest, what's been accumulating for days, weeks, who knows. Folks buy the contracts and they keep them. The OI change is what happens overnight. The calls or puts, we're looking at the calls right now, but any contracts that were bought overnight and held overnight, that becomes the OI change. So right off the gate, the market maker looks at the OI change first and determine who has the advantage, the calls or the puts. What is my risk? Because the market maker just wants to hedge. If folks are buying more calls, the market maker wants to buy the hedge against those calls that are out of the money right now, that could be in the money by the end. So right off the gate, we see a huge number of OI change in the calls, and it's also accompanied by the volume. Volume, after OI change comes the volume. The market maker is going to listen to the feedback. Whoever has higher volume, calls or puts, the market maker is going to add that to their feedback from the OI change and move the market accordingly. So as you can see, we have huge OI change from 604 all the way to 607. And it is accompanied by huge volume. And this is why I said we're probably going to hit 607 because after that 608, you see that the volume tapers off. So we're probably going to hit 607. Then if you look at the puts, you see also not a lot of OI change. That's why today the tape was pretty much a one-way street. Not a lot of open interest either. But we had volume today. So I thought the market maker probably, what they're going to do, hit 607, hedge against those calls, then push the tape down to 605, 604, because you don't have any resistance from the puts. You're only going to have to pay the folks who are buying today, and that's going to achieve maximum pain. Why didn't we go down to 605, 604, which is typically what the market maker would have done? 2 reasons. Reason number 1, if you look at the expiration dates of tomorrow in the calls, we've seen also huge volume for the 607. And this is why the market maker wants to stay closer to 607 just in case they need to hedge against that in tomorrow's session. The other reason is, we go back to the morning brief, it is NVIDIA. And I suggested that NVIDIA, we see a lot of calls at the 150 being bought. And NVIDIA has the biggest weight in the indices. If NVIDIA moves, it could move the indices single-handedly. And you saw at the end of the day, the market maker wanted to dump the SPY, but NVIDIA went higher at the end of the day. So there was a little bit of conflict. On one hand, the market maker wants to exercise maximum pain in the SPY by pushing the tape down to 604 to 605. On the other hand, you have those NVIDIA 150 calls being bought aggressively. So the market maker has to hedge against that before the end of the show. So what they did is bought NVIDIA, sold the SPY, and all in all, it kind of tapered and balanced each other, where the SPY didn't move down to those 605, 604 target. How do we use this kind of data in our advantage? Maybe if you're looking for a bullish breakout in the market, or you just want to hedge against your bearish positions, for example. The easiest way to do that is NVIDIA, because NVIDIA has the cheapest options right now, and it is the better looking chart among all of the big caps. Not to mention, of course, it has support from the 150 calls being bought for this week and the week after. So here's what I did. And this might look crazy, hey, Mav, you're insane. What are you doing here? But I bought the 150 calls, expiration date Friday, expiration date the 3rd, the 11th, and then I sold the 150 calls for the 18th. All in all, the strategy would cost me about $1.70 a piece, or $170 per contract. Now, what is the goal from this kind of trade? Of course, I'm financing my 150 called bets for the 27th, 3rd, and 11th by selling the 150 calls for the 18th. So you might think that this is counterproductive, but the beauty of this strategy is if NVIDIA blasts higher, above 150, I have the luxury of booking profits from my 150 with the expiration date of this Friday, or the 3rd, or the 11th, and all I need to do is more than $1.70 a piece to be profitable. And then at the end of the day, if we go above 150, the only downside to the strategy would be the time value that you're going to owe in the 150 calls that I sold for July. But on the other hand, you're going to have one of these 150s, preferably, of course, the 11th, still going in the money. And that's going to compensate you. So the strategy is to squeeze a profit from the 27th or the 3rd, and then keep the 11th and the 18th that I sold. 11th I bought, 18th I sold as the calendar strategy. And at that point, we can play with it even more. We can buy back the 150 that we sold for July and maybe sell a debit spread for the 11th at 155 or 160. So there are a lot of things you can do in terms of maneuver if you use this strategy. I know it's complicated, but we can talk about it again in Discord tomorrow. The bottom line is, I think that if you want to have any bullish bets right now, probably NVIDIA is your best bet. From price-wise, the premiums are still cheap. And the technicals, it's still looking the best chart right now in the mega caps at least. Let's add more color to this conversation by revisiting the market activities today, beginning with the closing of the indices. And here we go. All indices closing positive, with the diamonds up 507.24 points, or a gain of 1.19%. The Nasdaq up by 201.56 points, or a gain of 1.43%. And the Spider up by 67.01 points, or a gain of 1.11%. The leading indicator of the Russell 2000 is still looking good, up 2.70 points, or a gain of 1.27%. Looking at the sectors, it was a risk-on kind of strategy today, theme, led by technology, financials, and comm services. The laggard is energy again, as we see some of these geopolitical bets being taken off. Now, if I look at the performance of the sectors and then look at the weight of the S&P 500, led by technology, financials, and then comm services, consumer discretionary, which is the cyclicals really. When I see that, what does that mean? It means that today the majority of the buying happened by the algorithms, buying the ETFs, buying the indices, not the individual names. And thus we see the market performance reflecting the weighting of the index. Looking at the breadth, what do we see here in the NYSE? We have 70% advancing, 29% declining. The Nasdaq, 74% advancing, 23% declining. So the market maker got squeezed to the upside. They lost today. They had to pay the calls, which means that they've accumulated a lot of shares and they might push the tape down tomorrow to win against the calls that were bought today. Keep that in mind. Looking at the heat map, once again, the majority of stocks are up because we have a reflection of the weight of the index. They bought the SPY, the S&P, they bought the Qs. So pretty much you see weight distribution looking pretty good with the exception of Apple. So Apple is showing relative weakness, that even though they bought the indices, they probably sold Apple. So keep an eye on Apple right here. Of course, since we have the geopolitical premium being taken off, we see the defense contractors down, we see energy down, we see the gold miners down. But like I said, the dips here, 2 to 3 days max. I think all of the geopolitical hedging will be washed out and the dips will be bought in these names. Then we have Tesla down about 2.25%, but we have Uber up about 7.5%. I think this is the market's way to say that Tesla robotaxis was a flop and a disaster, which it is. But I think that from a mechanical perspective, we need to see Tesla losing 340 before the pain begins. Looking at the heat map for the ETFs, right off the gate, we see geopolitical hedging being taken out. So energy is taken out. You see XLE, XOP down, USO down, UNG, all of energy down. You see gold miners down. You see GLD, you see silver down. And that's going to affect, of course, anything that is risk-on, like financials, like technology, like the transports, communication services, biotech, positively. So you see the XBI, for example. Biotech is one of the biggest gainers today. Then, of course, you have reduction in volatility. So you see the VIX down as this geopolitical hedging is taken out. And that's going to be reflected positively on the indices from an algorithmic perspective. But like I said, this is going to be by the day, the 3 days max. And then what? Then we have to face the trade and the Fed policies. Moving on to commodities, again, we see a little bit of outflows coming out of energy. And I think, again, 2 to 3 days, that's going to taper out. And then we're going to see rebounds in energy. And I think that the crude oil, Brent, WTI, but if you look at light crude, really, that's what I track. 64 is the support. So today I saw the naked puts at 64, and I raised pretty good cash here. It was about $800 per contract. So if you think that we're going to see a rebound in energy as I do, this is one way to trade it, is to sell naked puts with the expiration date of the 27th. This is the one that I did in Discord. And you're getting about $800, $8 a pop as a hedge. I think it's pretty much a steal here. Then we see softs down across the board with the exception of cocoa up about 3%. Of course, the dollar is down, which is supposed to be good for commodities, but right now we see the reflection of the dollar going down in the Japanese yen, the Swiss franc, and the British pound, the euro, Bitcoin, but we don't see it in commodities yet because you have grains down, grains attracting, of course, crude oil. Then you have in metals, you have gold and silver, and to a certain extent palladium, which are considered defensive. And a lot of folks hedge the geopolitics by buying gold, silver, palladium. The weak hands have to get out first, and then look at the declines that we've seen in the dollar. I think that's going to be reflected positively in gold, silver, and the rest of metals, and even the rest of commodities. So again, 2 to 3 days max, then we'll see a rebound in commodities. And we are already at day 2. Bear in mind, because a lot of folks right now are saying, oh, oil is dead, oil is not going to come back. But look at the oil rig count. It's been collapsing. They're not drilling anymore. I know the president says drill, baby, drill. Well, nobody's drilling because they're not stupid. When the price goes 65 and below, there's no reason for them to drill. They need to push it back up 70 or above. So we do have some support here in the market. Likewise, we have the tankers. Today we got the headline that many insurance underwriters would not offer Middle East coverage to the U.S. So any vessels, any tankers going through the Gulf, taking oil from Saudi, Kuwait, Iraq, UAE, Iran, whatever, they're going to charge more. And that's going to be reflected positively on all oil tankers because it is, again, a worldwide market. So even if you're a tanker that does oil from Norway, for example, because of insurance costs going higher across the board, and there is a lack of supply now for Middle Eastern oil, all of these rates will go higher, and the oil tankers will have to charge the customers more. In other words, you have a case of price gouging. And this is why I'm going to stick to the oil tankers right here, despite the pullbacks that we've seen recently. I'm actually doubling down on those shares. Moving on to the big casino options, what do we see here? The volume's still tame. It increased a little bit in NVIDIA, so watch out for NVIDIA here. IV rank still is 0. Really, really cheap calls, cheap puts, whatever you like. You see the volume in Tesla, but there's something interesting in Tesla. Look at the puts to calls volume, the last column. When you begin to see that put to call volume increasing closer above 70, 75, and then you see the IV rank not at 100, that's going to suggest that the stock will go down. And right now we look at 75 put to calls ratio in the volume for Tesla, and then you look at the IV rank at 30.5. That tells me that Tesla probably has plenty of room to go to the downside if it wants to. And of course, the put-to-call volume ratio is more accurate if you track it day by day. If you see how the put-to-call volume is increasing or decreasing. If it is increasing, you know that the stock is about to pull back. If it is decreasing and folks are buying more calls, let's say after a sell-off in a certain stock, that's your indicator that we're probably getting close to a bottom and a rebound, or we're about to see a breakout in that certain stock. So keep that in mind. So when you see, for example, Amazon, the put-to-calls ratio 35 or Meta 36, these are not the best shorts that you want to enter. You want to enter something above 50, and it still has a low IV rank, like Apple, like Tesla. To a certain extent, maybe we're beginning to see that in AMD with 51 put-to-calls volume and a low IV rank. So if you have AMD, as I said in the stream today, good opportunity for you to book profits and maybe hedge a little bit. If you want to speculate just as a trader, maybe it's good to speculate on a pullback in AMD. Look at what happened to CRCL today, down about 15%. So what happened? What happened is we have, and again, the IV rank is not really accurate. This is a newer stock. The IV rank tracks the 1-year data, so we don't have enough data here. But look at the put to calls volume and compare it to the last few days. It has increased dramatically to 1.31. And that, of course, broke the stock down. As the traders begin to buy more puts, the market maker has to sell. So the PC volume is really, really important. And I'm going to do a series of courses here, video courses on how to use all of this data, because I think we have a lot of questions about this topic right here. And a lot of folks are confused. So we need to do at least 2 videos, one for the zero DTEs, one for the put to calls volume ratio, IV ranks, and how to combine the data. and make trading decisions. But for now, let's move on and do the unusual activities. Beginning with the bullish ones, we got about 2 of them here. Yep, we got 2. We begin with NOW for ServiceNow. The stock is trading at about 1,000. Somebody sees an increase of about 10% coming by September. This is why they bought the 1,100 calls for September 19th, 2025, spending about a little over $5 million. They're betting bullish on software because the next one you got is TTD Trade Desk. I think that we did look at it in the stream today for the Top Guns. I suggest that we probably going to break to the upside here. Bull flag breakout. Somebody agrees with me. They bought the 72 calls July 18th. They spent about $800,000 in those. I went with the 75. I already own shares at 70. I bought the 75 for July. If we break above and close above, we'll exercise and add to my shares in Trade Desk. Then we segue to the bearish trades. How about the Qs? Everybody's being bullish right now, thinking we're going to break to the upside, but there are traders who disagree. Here's one of them. They bought the 530 puts for the expiration date of September 19th, spending about $11 million. We're trading about 540 right now, so it's not really far out of the money. And you look at the next one here for the SPY, diagonal put spread. This is really interesting. The SPY right now trading at about 605, 606. They bought the 593, the expiration date July 11th, 2025. They sold the 585 for July 3rd. All in all, they're spending about $2.25 million. What's the point of this strategy? They're betting that by July 11th, that is, we'll be below 593. But we're not going to be below 585 before July 3rd. So they're using that leg to finance the 593 puts they bought for the 11th. Diagonal, that's what we call diagonal put spread. I like it. Then we got NVIDIA puts. See, somebody disagrees here. They see that NVIDIA probably going to head down. They bought the 146 puts, the expiration date July 11, spending about $3.5 million. I would still say if you're going to bet against the market specifically, your hedge should be NVIDIA calls. If you want to bet for a breakout, just speculate. I still think that NVIDIA is the cheapest and the best bet here. Next, we have BABA. We talked about BABA last night, that with crude oil going down, probably going to see Chinese names rebounding, but somebody disagrees. We're trading right now at 117 in BABA, but somebody bought the 110 puts, the expiration date September 19, 2025, spending about $1.25 million. Let's do the charts and then wrap it up. We begin with the E-mini futures for the S&P 500. What do we see here? You got a sort of a false break out of the wedge here. Touched the 200 days moving average, moved higher, and I think that usually 9 times out of 10 when you see this phenomenon right here. False break to the downside, false break to the upside, and you come back down again in consolidation. That would be my 2 cents, but obviously right now, if you're betting one way or the other, if you say, hey, it's going to be the upside or the downside, right now the evidence say it's going to be the upside because we've already retested the 200, got a big rebound out of it, got a confirmation out of it. We closed at the highs higher than this week right here, which was 6,126.5. So the technical evidence right now is tilted toward the bullish case. But as I said, you have to also assess the evidence as we talked earlier in the video. I think an important indicator would be the IWM tomorrow because we got a rejection here at the 200 days moving average. We're about to retest it again. I think a break above the 200 days moving average in the IWM would be the confirmation that you need that we have a break to the upside of the market. If we have another rejection here at the 200 days moving average and we go down, then forget about it. Perhaps the IWM is going to lead you toward forget about it. It was just a couple of days worth of geopolitical hedging being taken out, arousing the algorithms to buy. But now that's over with. We're going to assess the Fed policy and the trade policy, and we have a lot of uncertainty. So the 200 days moving average IWM is really important indicator for this week. Looking at the dollar, it is breaking down, but is it oversold? Not yet, so we could see more declines to come in the dollar. And right now we have a little bit of support right here. If we break it, we continue to flush down, and then we look at the weekly chart, and we're probably going to head down to these levels right here at 95, 96. If we get that breakout, of course, this is a weekly chart. It's not going to happen in a day or two. It's going to take a few weeks before that happens. But right now, the safe bet is weakness in the dollar, continue to bet on the Japanese yen, continue to bet on the Swiss franc, the euro, A viewer today brought up the Singaporean dollar. Any of these currencies will do pretty good as a hedge against the dollar. And of course, you got the old man gold. Right now, it's kind of struggling at the 50 days moving average, but like I said, a lot of geopolitical hedging being taken out. I think that's going to last. So Monday, Tuesday, maybe if we extend it really tomorrow, Wednesday. And then they're going to be all out. The weak hands are out. And I think that gold is going to find some footing. If it doesn't, if it begins to go down, then we have a case of outflows out of gold and inflows into the stock market. And that's going to be really, really bullish. But right now, I don't see it happening. I see a rebound coming in gold. And of course, what do you do with the GDX gold miners? You got the gap right here. It closed. We have a nice candle, looking candle, not a confirmative candle yet, but we're above the 50, we're above the gap. So I think that if gold rebounds tomorrow, GDX will move higher again. The Big Kahuna Apple hourly chart, what do we see here? A reminder again from the heat map discussion. It was sold today while the indices were bought. So that's relative weakness for Apple. Now we got a rejection here twice at about 203. You have momentum rolling over in Apple. Do you short it? I think so, but maybe you want to wait till the 200 is lost, this support, because there is a case that we could still see sort of an inverse and shoulder support right here. So a loss of 200 will be for me. The permission is short Apple right away, and the target will be once again 196.5. As NVIDIA goes, so will the market. False breakdown of the falling wedge, and now we're back in the wedge or breaking higher. If NVIDIA makes it to 150, it's going to drag the market higher. It doesn't matter what Apple does, doesn't matter what the others do. It's all about NVIDIA. As NVIDIA. The old saying used to go, as Apple goes, the market goes. But now it's as NVIDIA goes, so will the market. Do I short NVIDIA here? No, you got to see another loss of 145. Otherwise, you're better off using NVIDIA as your hedge against any shorts you got by buying the 150 calls. The souffle Tesla. Have we eliminated the bull flag pattern right here? Yes, because we pretty much closed below half of the body of the flagpole. But is it a confirmation that you short Tesla here, that the optimism of the robotaxis is fading? There is a case to it. There is maybe a formation of a bear flag right now. Losing 340 would be a confirmation. Losing 333.33 will be the ultimate confirmation. So we're getting really close here. And I think the case is not good for Tesla. We see those videos. It's just not looking good for the robotaxis. As I said, it was rushed and it just doesn't compete with Waymo, Uber. So it's going to be a problem for Tesla here in the next coming days. And lastly, tulips. Bitcoin, what do we see here? Above the 50, above 104,000. So yeah, there is a case that it might go down from a higher or lower high pattern and then lower low. That remains to be seen because there is a shift in momentum that could happen from bearish to bullish. So right now, Bitcoin looks okay since the dollar is heading down. But if we see a loss of 104,000 again, a loss of the 50, my assumption would be that Bitcoin has to go down all the way to the 200 at about 96,000 to find some support. So right now, hold your horses. The assumption is Bitcoin is still bullish, but if it loses 104,000, we got a short all the way to 96,000. Moving on to the conclusion of this video, what do we have in the economic calendar tomorrow? The 25. Got nothing. We got new home sales important, but not really that much of a market mover. On the earnings calendar, after the bell, we have Micron. That could be a big one because Micron been just rallying. So the bar is way too high. And then we have, before the bell, on the 25, we have General Mills. I don't see good things happening here based on the recent earnings that we got from similar companies like Smucker, for example. But we'll see. I think the pet food segment will be weak, but cereal could be a winner here. We'll see. But besides that, folks, again, we're going to be done pretty much with removing the geopolitical premium, the bets on oil, the bets on gold, the bets on the VIX, and that caused an algorithmic pump. But then what happens? We got to focus on the Fed policy, the trade policy, and that's what we're going to do from here, unless, of course, the geopolitical situation flares up suddenly. But with that, folks, I hope you enjoyed the show and found it informative. And this is all I got for you for now. Thank you for listening. Thank you for watching. I appreciate and love all of you. I'll be talking to you again tomorrow. Good night.
I don't know, maybe it's a misfucking understanding here. I don't know, man. Maybe you don't remember me. My name is Benny.
Maybe I don't give a shit. Maybe I don't remember the last time I blew my nose either. Who the fuck are you? I should remember you. Huh? What, you think you like me? You ain't like me, motherfucker. You a punk. I've been with made people, connected people. Who you been with? Chain snatching, jive ass, Maricon motherfuckers. Why don't you get lost? Go ahead, snatch your purse.
All your love.